My name is Nat Kellogg. I'm the Director of Managed Research at Marquette Associates, and I'm going to be talking about the investment case behind ESG investing and how we're seeing investment managers implement this in practice. The agenda for this talk is as follows. First, we're going to cover what is ESG investing. Then we'll talk a little bit about the investment case for ESG, how and why we see investment managers implementing ESG factors, environmental, social, and governance. Then we'll talk a little bit about the trends we're seeing in the marketplace. And last but not least, talk a little bit about our approach to ESG investing and where we see this going in the future. So what is ESG investing? ESG investing is the incorporation of environmental, social, and governance factors into the fundamental investment process. Attitudes to ESG investing have certainly changed over the years. This is a cartoon from Pensions and Investments magazine back in early 2013, and I think nicely sums up some of the concerns that investors had at the time. There was this view that ESG investing required a trade-off. Either you could do well with your assets or do good with your assets, but it was difficult to do both. But have times changed? 5 years later, this cartoon is from the same magazine, and I think nicely reflects the current view on ESG, which is that thinking about ESG factors and incorporating them into the investment process can help managers drive alpha in client portfolios. So what we're going to do this morning is talk a little bit about what those factors are and how we're seeing them used and implemented in client portfolios. From an environmental standpoint, increasingly we see environmental factors used to help manage and identify risk in portfolios. So one good example of obvious risk has to do with environmental disasters and the associated liabilities. The first example on the left-hand side is ExxonMobil with the Exxon Valdez oil spill back in 1989. Now, this is something you're probably all very familiar with. It was obviously a public relations and environmental disaster for ExxonMobil. What's interesting looking back is the overall liabilities associated with this were relatively modest, just $7 billion. Looking at things today, it's considerably different. So this middle picture is from the San Marco Dam collapse. San Marco is a joint venture between BHP and Vale. It's an iron ore mining company in Brazil. It had a dam collapse that wiped out a number of towns in Brazil, causing $54 billion in total liabilities. And then last but not least, the largest one of them all, the Deepwater Horizon oil spill back in 2010. Deepwater Horizon was an underwater oil well owned by BP, and BP has paid out over $60 billion to date related to this disaster. So how did the market react to these environmental disasters? What we're showing you here is the stock price performance for each one of these three companies in the immediate 100 days after the environmental disaster. What's interesting you can see here in the blue line, looking at ExxonMobil, is that the stock price reaction in the market was relatively muted, sort of consistent with relatively small overall liabilities. Contrast that with Vale and BP, where their stock prices declined somewhere between 40 and 60% peak to trough in the 100 days immediately after the event. As an interesting aside on BP stock was trading at about $60 a share in the month leading up to the Deepwater Horizon oil spill. Today, BP trades at about $35 a share, and at no point in the last decade has BP ever eclipsed or regained that $60 a share mark. Another thing that people are increasingly focused on is stranded assets. So when we think about resource companies, both energy companies as well as mining and mineral companies, a lot of their value today has to do with assets that still remain in the ground that are expected to be extracted in the future. But what happens if shifts in demand mean those assets never get extracted? I think a good test case for this is the US coal industry. So on the left-hand side of the chart, we show you coal production and consumption in the United States going back to about 1950. And you can see that peaked back in 2005. In 2005, coal-fired power plants accounted for half of all electricity generation in the United States. Fast forward to today, 15 years later, and that's down to just 27% of all electricity generation here in the US. The effect on the coal industry has been devastating. On the right-hand side of the chart, we show you the performance for the Dow Jones US Coal Index. This is an index of publicly traded coal producers here in the United States, and you can see the performance over the last decade has been abysmal. At the very trough there, back in late 2015, early 2016, essentially every coal company in the United States went through some sort of bankruptcy or restructuring. So if environmental factors help identify risks, social factors are increasingly being used to help identify companies with strong competitive advantages and the ability to outperform. I think a great example of this was from a Credit Suisse study back in 2016 that highlighted the fact that companies with a higher proportion of women in senior management significantly outperform their peers when you're looking at return on equity. What's interesting is they were able to do this not with financial engineering, but fundamental improvement. So you looked at those same companies, and not only did they outperform from a return on equity perspective, but they were able to do that with less leverage, a lower overall net debt to equity ratio. Diversity is one social factor people look at. Another good example of that would be looking at employee satisfaction and fair labor practices. An example of that kind of research came out from Glassdoor earlier in 2019. And Glassdoor is kind of an interesting website. It lets employees go on and anonymously rate their employer. You can rate pay, performance of the company, satisfaction with the CEO. And what Glassdoor found was there was a strong correlation between a company's Glassdoor rating, i.e. employee satisfaction, and the consumer satisfaction as measured by the American Customer Satisfaction Index. This link was particularly strong in more consumer-facing industries like transportation, hospitality, and retail. Now, it's important not to confuse correlation with causation. We are not trying to say that solely focusing on these social factors will immediately improve operating performance. Rather, what we're saying is that increasingly people want to work at employers with diversity in their leadership, that treat their employees well. And these are indicative of firms with strong culture that generate strong operating outperformance. I think James Haskett from Harvard Business School professor said it best when he said, an organization's culture can be its best competitive weapon. How many times have you heard a CEO say, our people are our most important asset, or we have a terrific culture? But put yourself in the shoes of a financial analyst. From the outside looking in, it's really hard to know whether or not that's true. But increasingly what we're finding is that these social factors and firms that do well in these social factors are indicative of firms with strong cultures and consistent and lasting competitive advantages relative to their peers. Lastly, let's talk about governance. And governance is something that has been core to the investment process for a long time, thinking about alignment of interest, thinking about capital allocation policies. But one thing that we have seen change a little bit is how we define the term active management. So historically, when we talk about active management, we're talking about a manager actively managing their portfolio, which meant buying and selling securities. But increasingly, active management also means being actively engaged in improving the portfolio companies in a manager's portfolio. What we're showing you here is the number of activist campaigns that have been launched in the United States over the last decade, and as you can see, that's steadily increased. One of the other interesting trends that's going on beneath the surface here is if you go back to 2010 and 11, this was almost exclusively the purview of the hedge fund community. And while hedge funds remain very active in this space, the long-only community has increasingly become activist as well. What are shareholders asking for when they launch proxy contests? As you can see here, many of the typical things they're fighting for have to do with reducing conflicts of interest, i.e. political contributions and lobbying, as well as improving corporate governance, requiring independent chairman of the board, declassifying the board, or the ability of all shareholders to call special meetings. One other thing that's very important when we think about governance is incentivization and compensation. So I think this was some interesting information we were able to pull from Bloomberg. Bloomberg now has an ESG module for every company in their database, so you can see how that company scores on a number of different ESG factors relative to their peers. This is one example where we look at GM, Ford, and Tesla. Now, one of the things that's interesting is when you look at their board governance construction, it's actually relatively similar. GM has a little bit more diversity, but overall pretty similar scores. But after you look, Tesla's overall score from an ESG perspective is surprisingly poor, especially given the fact that they do very well in environmental factors. But one area that Tesla clearly falls short on has to do with CEO compensation, where Elon Musk's compensation is off the charts relative to his peers. So let's spend a minute and look at some of the trends we're seeing on the ESG landscape today. Interest is clearly on the rise. So this is a Google Trends analysis of the search term ESG investing. And as you can see, interest has never been higher. I think this is really important for us to remember as fiduciaries, plan sponsors, and advisors that our plan participants are asking about and interested in ESG investing like never before. Not surprisingly, you've seen institutional investors vote with their assets. So the percentage and the number of ESG assets in the US states managed with some sort of ESG criteria continues to rise. Not only are we seeing asset managers and asset owners focus on ESG, but you're also seeing the underlying companies themselves. So if you go back to 2011, only 20% of the companies in the S&P produced an annual sustainability report. If you go to 2018, that had increased to 86%. I think a culmination of this is when the Business Roundtable came out in August of 2019, redefining the purpose of the corporation. Now, the Business Roundtable is a nonprofit organization made up of C-level executive at Fortune 1000 firms, and they announced a fundamental shift in what they said the purpose of a corporation was. No longer was it solely to drive returns for shareholders, but it was really a commitment to all stakeholders, customers, employees, suppliers, communities, as well as shareholders. This was signed by the chairman and/or CEO of over 185 public and private Fortune 1000 firms, and we give you a list of some of the signees here. Now, as ESG continues to gain traction, we're oftentimes looking for a common language for discussing ESG initiatives and their effect. And these have increasingly become the Sustainable Development Goals, or the SDGs. Now, the SDGs were laid out by the United Nations as part of their 2030 Agenda for Sustainable Development back in 2015. And we're increasingly seeing investment managers and asset owners use these as the tools for guiding what they think is important from an ESG perspective and communicating what they've been able to accomplish. Now, one of the obvious questions to ask is this having an effect? Is this working? And while this is only one example, I think the answer is yes. So what this chart shows you is the percentage of women on corporate boards for MSCI equity companies, and we break this down by industry. And while there's clearly a lot of work still to be done, you can see the trend is clearly in the right direction, and there clearly has been some changes over the last decade. Now at Marquette, we have spent a lot of time meeting with investment managers about ESG, looking at ESG dedicated strategies, and also seeing how investment managers incorporate ESG into their process. And here's our view on a few best practices when looking at folks that are implementing ESG. First and foremost, it's important to have dedicated ESG resources. That's people and data focused on ESG. We want to see investment managers with a systematic scoring system for assessing companies on multiple ESG factors and the ability to score companies across industries and across sectors. Incorporating those ESG insights into the security selection process is incredibly important, but it's not just about screening. We also want to see internal resources focused on proactive engagement. So that's both voting proxies, launching proxy campaigns, and actively engaging management. And then last but not least, as fiduciaries, we need and want to see clear and measurable reporting. It's not enough for a manager to say they do ESG, but we want to see how it's measured and how it's reported. And last but not least, we'll take a quick minute and look into our crystal ball on where this is all going. First and foremost, I think you will see that ESG criteria will increasingly become included in all investment managers' processes. This will become sort of the default. Much like we ask folks about their trading practices or their technology backed office and disaster recovery, I think increasingly this will just become standard operating procedure in the marketplace. I think this is true at all levels. So at the company level, thinking about corporate responsibility and sustainability. At the asset manager level, using ESG criteria in the security selection process. And at the plan sponsor level, incorporating ESG considerations within the investment policy statement. And then last but not least, this is a really exciting opportunity for both asset managers and asset owners. For asset managers to redefine how we think about active management and what it means to be engaged with portfolio companies. And for asset owners, not only to do well with our assets, but also to do good. I want to thank you for listening to this talk. Appreciate your time.